Right. So whenever you're in the market, you're going to experience these um two kinds of scenarios or two kinds of participants. We always have the smart money and the dumb money. Smart money is simply this is capital that is being controlled by institutions, central banks, and all the big investors in the financial markets, all the big institutions, all the central banks, all the big hedge funds. They are their capital or their money that they pump into the forex market is actually referred to as the smart money. Why is it referred to as the smart money? It's because of the nature in which it moves the market. Those are those are monies that actually can move price either to go up or to go down. So when they put their money in or take their money out of the market, it actually has a huge visible impact on the price or on the movement of the market because these people they pump in millions and billions of dollars into the market. So the opposite of that is dumb money. Dumb money, this is also called retail money. Retail money, this is simply capital that is invested by retail traders. Obviously, dumb money, those are monies that are they're not billions, they're not even millions sometimes. They start from the least amount of capitals that you know, the $50, $100, 500 to 1,000, 10,000, 50,000, 100,000. All of that is referred to as dumb money because um, it does not really move the market. It doesn't move the market. It's simply it's simply retail traders trying to make money out of their little money that they put into the market. So how can one survive in a market where the price is being moved by the smart money people whilst you are a dumb money person? One actually needs to follow where the smart money guys are going. If the smart money guys are buying and you also buy with your retail money, you are guaranteed to make money. If the smart money guys are selling and you also sell with your retail trading money, you are guaranteed to make money. The challenge comes when you try to go against these big guys or these smart money guys. Let's say they are buying and you try to sell whilst they're buying. They are going to utilize your stop losses or they are going to utilize your your small money as their own liquidity. I'm going to explain what liquidity is in the following episode. They are going to use your own money as liquidity that they need in order to move where they want to move price to. So, hence, it is very crucial for one to understand how smart money or institutional trading operates. Because if you don't know where the institutions are placing their orders or where they are taking out their orders, it means you're always going to trade with a blind man's mentality because you're only focused on one side of the market and you don't have the other side of the market where the cause of things is coming from. So that is why it's a must that each and every single trader must understand institutional trading. If you don't understand institutional trading, you're always going to be a victim to the market. So if ever you don't want to be a victim to the market and you're not surprised on the movement of price on the market, you need to understand and start learning about institutional trading. Institutional trading will help you to understand what causes the market to behave the way it behaves, what causes price to go up, what causes price to go down, what causes price to fluctuate in one position, what causes price to go up and come back to the same position before continuing to go up. So all those things, you only understand them once you start to delve into wanting to learn and to understand institutional trading. So having known all that, you will realize that the difference between smart money and dumb money is a very, very big difference. And it's also the difference that can actually separate the profitable traders and the non-profitable traders. Because most of the people, most of the retail traders, they are simply trading from a victim point of view, because they are just surprised things they happen, and they don't even understand how those things happen, because they don't understand institutional trading. Once you understand institutional trading, you actually know the reason behind why price is going up, why price is going down, why price is ranging, or why price is going up, coming back down, going up, coming back down, going up, coming back down. You start to understand all the sort of like behind the scenes of the market. You now have a behind the scenes point of view. You now have a behind the scenes perspective of the market. And when you have such a perspective and you are a retail trader who now understands institutional trading, it means you're going to be far much ahead of the rest of retail traders that are out there, because you're always going to be at a far much bigger advantage than them, because you're no longer a victim, but you're actually part of, you actually know what is happening, and you actually know where the smart money guys are putting in their orders, where they're taking out their orders, where they are most likely to take out retail traders through their stop losses as liquidity. You actually know all of those things because you've invested time to understand institutional trading. So this is going to be a very, very interesting series. You start to understand some of the reasons why many of your stop losses were being taken out, and after the stop loss has been taken out, you see the market going where you're expecting. You actually understand in this series that the majority of the trades that you lost, you're not even supposed to lose them if ever you understood institutional trading. You also understand how to not be a victim whilst your stop losses are being used as a liquidity by the big guys there.